recording is on. Hopefully it doesn't interfere. All right, so folks, let's go over some training. A lot of times a lot of you have asked, okay, so how do I trade? How do I make a trade decision? What's the meaning of life? Stuff like that. Just how many stars are in the universe? Whatever. Um, so let's go over some of those things. Can everybody hear me okay, by the way? Yes, no? Okay. All right. Okay. So firstly, let me set this up so it actually looks like it's supposed to. All right. So I'll start off by saying trading is not easy, but it's not as hard as sometimes we make it out to be. Okay? Now, if you notice on my chart, there's not a lot here. There's a volume display at the bottom. Doesn't even have to be one at the bottom because we have other information we can look at. But I'll just give you the quick rundown. These are the specific things that I typically use. Okay? So number one is I do use I pay particular attention to any information about pending orders. I strongly believe, and I strongly have observed, that pending orders mean more than anything else because that's the actual. There are two things that matter the most. This right here, which is the order flow. These are market orders that have been filled. Now, if a market order has been filled, there's only one way possible that could have happened, and that is there was a limit order that matched up with that market order. That's the only way this ever happens, guys. If both orders were market and there were no limit orders in existence, if all we had were market orders, what would determine the price that the execution of the trade would happen at? Think about that for a second. If 100% of all orders in existence in the universe, if all of them were market orders, so I say I want to buy, you say you want to sell. I want to buy 100 shares. Yeah, I want to sell 100 shares. What's going to determine the price? And the answer is nothing because there'd be no price to reference. There'd be no quote. There'd be no bid. There'd be no offer, no ask. If there's no bid or ask, where am I going to get filled? I wouldn't know. So what could we do to fix that? Yeah, you see that, right? I didn't see it, but you're right. It happens. Okay, sometimes it does happen. I don't know how, but it can. So, folks, anytime there is no bid and there's no ask, trading ceases to exist. There can be no trading unless there's a bid or an ask. There has to be someone that says, I will only buy at this price or lower, and someone who says, well, okay, well, I'll only sell it at this price or higher. Market orders basically say, I'm willing to get into the stock now at whatever is the current best available price. But what they're actually saying is, I'm willing to get in right now at or near where the market is currently because I don't think it's really going to matter. I think things are going to move so fast in the right direction that I don't have time to wait. Market orders always mean urgency, that you're saying, whether you realize it or not, you're saying, I don't think it's worth waiting to get in. Okay, so it'd be like you go to a real estate auction and you just say, I'll take whatever price you give me. If you say that, unless, if you got the money to pay for it, they might say, okay, well, they throw some astronomical price at you, say, fine, I'll take it. Now, why would someone do that? Well, maybe they know that there's a gold mine underneath that house, or maybe they know there's an oil well underneath that house, and they're not really concerned, right? But in reality, most of the time we're going to have some concern about price. So when you do a market order, it's not literally saying you'll accept any price possible. You're saying you're going to accept any price that currently is near the market now. So maybe you do pay a few cents more than you want, no problem. Maybe you even pay 50 cents more than you want, still no problem. As long as the price is not far away from where the market is now, you accept it. All right, so that's a market order. So if there were only market orders, trades could never take place. But what actually is going to happen is if all we had were market orders, right? And one person says I want to buy, and the other person wants to sell, naturally they're going to start saying, well, what price are you willing to buy at? You know, in other words, whoever is least willing to change their mind is going to win that battle. If there's only a buyer and a seller, whoever's least willing to change their mind is going to force the direction that goes, right? So if the buyer's unwilling to budge, but the seller is, then the seller is probably going to move to the buyer. If the seller is unwilling to move, but the buyer's going to move up to the seller. That's it. So limit orders are the people who are trying to get in to the market or out of it, depending on which way they're going. They might be exiting, they might be entering. But limit orders are the people who are basically saying, look, I'm okay if you give me these shares at this price, but not any higher. Or I'm willing to sell at that price, but not any lower. So the people who actually have a commitment that they're saying, hey, I am not going to accept anything else than that price, whatever my price is, then those people are going to wait for some market order to get to them. Now, if my price is 189.12 to sell Tesla at, which is way down here, I have to wait until all the people who are in front of me who have other orders to sell at lower prices, I got to wait till they're all cleared out before the market gets to me. And what does that mean? That means there have to be enough market order buyers to take away this, everything until they get to my price. And however many shares that is, that's exactly the number of shares that have to be taken out before they get to me. So my price will have to wait. The market has to go through the available inventory of ask prices, as I like to say, the shelf of ask prices. They have to dig through all of them before they finally get to where mine is. And if they're not enough buyers to get through all of these, then my price never gets hit. Simple as that. Okay? So this is what makes the market move. The interaction between this and that. This only happens because there are orders already here that these market orders can actually go to. So if someone's selling, there's a bid to sell to. If someone's buying, there's an ask to buy from. If these guys disappear, there is no market. Also, if these guys disappear, there is no market either because the limit orders would never touch each other. The bid's always going to be lower than the ask. So you would have these two sitting there forever, for all eternity, and they would never hit each other. Okay? So in short, you need both. You need buyers who are aggressive to buy from sellers who are passive. You need sellers who are aggressive to sell to buyers who are passive. Make sense so far, guys? Any questions about that? All make sense? Okay, it looks like one of you is still typing, so I'll move on, but all right. Now, what that means is this. This chart here is the result of this. All this chart is doing is keeping a visual history of what happened here. Okay, so every time a trade takes place here, the chart's tracking it. So every time I see this thing tick up or down, right, which we can see here, right, if we zoom in, you see this little bar ticking up and down, right? Every time that goes up or down, it's matching what happened here. So if the price here goes up, this moves up. If the prices here go down, that moves down, right? All it is is a history of what happened here, but it's a summary of it. It's not telling me every last individual detail about how many shares there were exactly and exactly what time it happened. All it's doing is doing this. It's telling me in the last 1 minute what was the highest price that streamed here, what was the lowest price that streamed here, what was the beginning price at that time, and what's the ending price when it's over. And it's going to count up all the volume of shares that occurs here in this column. It's going to add them up as a total, and that's what's down here. So this down here is just a summation of everything that happens in 1 minute on this, keeping track of all the last sizes. And this right here is just a price history. What was the high? What was the low? What was the open? What was the close? That's it. It's nothing more. And what that means is the shape that this takes, this chart, that shape is showing me basically how the order book and the volume, the order flow, interacted with each other. So in other words, if you see a sharp move down, that means that the flow of sell orders coming in here were larger than the amount of bids that were already there, and therefore the price went down because they were able to run through that inventory of bids. There were enough sellers in the stream of trades, of market orders, to actually move the price down substantially and quickly. The sharper the angle down here is, the more selling pressure there was here that overwhelmed the bids that were over here. Does that make sense? All clear? Okay. And of course, if the market sharply goes up, that means that you had a lot more buyers overwhelming the sellers. The sellers couldn't find enough shares to sell because the buyers kept coming in and say, I'll buy more, I'll buy more, I'll buy more. Okay? So if the stock goes up very quickly, that's what's happening. You have an imbalance. When the stock can't make any headway whatsoever, like it does here, that means that the shifting of buying and selling is so evenly matched that you can't get out of that range. It's just basically every time you get a wave of sellers, they're counteracted with a wave of buyers. And then you get another wave of sellers, and you get another wave of buyers, and they go back and forth, and we call that balance. When the market is neutral, it's in balance. There's no dominant force. Buyers are not dominating, sellers are not dominating. The tug of war is basically evenly matched at that point. So throughout the day, you're going to have periods of neutrality where the balance is pretty stable. You're going to have other times where you have strong trends where the balance is not stable. And you'll have other times where you have gradual trends where the balance is slightly biased, either negative like here or positive like there. So all a trend is a persistence of activity on the order book and the order flow. It's just a persistence where you keep seeing much of the same thing happening over and over. So basically you have a selling imbalance that's building up as you go down, and then a buying imbalance that's building up as you go up. Now, having said that, that means that when we look at a chart, if we already know that this is the stuff that's actually creating the movement, it would make sense when we see movement to look at this and figure out, okay, when might I be able to get into a trade? So the short answer is, if I see a trend's going, I wait for the trend to actually slow down and basically go neutral. Remember I said there'll be periods where the balance is neutral between buyers and sellers. There's not a huge advantage on one side or the other. That's when the stock starts to trend sideways, right? And then once it's trends sideways, what you're looking for is for the trend to resume back up. You don't know if it's going to. There's nothing about this that tells you what the future holds, but we can watch it. So let's say we see the trends up, our trading tools, our Bollinger Bands with the weighted moving average in the middle, or VWAP if you're using that instead. Either way, it's showing us that the trend is generally going up. Now, the tools are just a way to summarize even further what the chart's showing. Whenever you look at technical studies, that's all they really do. They simplify something that's a little more complex. They basically say, generally speaking, things are going down. Generally speaking, things are going sideways. Generally speaking, things are going up. So that's all we use them for. They don't tell us what's coming next. They just tell us what's already happened. What we do is we pay attention to how changes in the market tend to occur. We pay close attention to, okay, if I have a stock that's moving in a trend down, how does the trend usually change direction? What does it usually look like when the trend is changing? By recognizing that pattern, we're able to anticipate when we might be seeing a transition. So, for example, right now, we have the stock trading below the bottom of the channel. Now, if the trend line is mostly up or flat like it is here, we might anticipate that this is going to turn around and resume back into a trend. Again, normally when the trend resumes, the trend line here is not going down. It's just either flat or slightly negative, right? But it's not really going down. So if we see the price suddenly drop to the bottom of this channel and start to move back up, it's not a guarantee that it's going to keep going up, but it's a pattern that we can recognize that right there, it appears that the stock was ready to go back up. But at the moment, it does not actually appear that that's the case because we see a slightly different pattern. The trend is pointing downwards, on the line at least. Even though we're at the bottom of this range, we would perceive this as being less likely to win if we were to buy right now. We would perceive that as more likely to win if we buy after it starts to come back up because it actually looks like it still wants to go back up. It's not that we know something is going to happen. We just know what's more likely to happen than not based upon our experience, based upon us taking the time to look at chart after chart after chart after chart until we get some idea. Now, here's another example. Here, the stock was going up, right? It tried to go up here. So it was going up at the time. It didn't finish going up like it did here. This one here, it finished going up. This one, I'm sorry, where was I just looking? Right here, it didn't finish going up. Now, if I jumped the gun on that, which is fine if I did, nothing wrong with doing that, I would have to recognize right away that this doesn't look like it's following through because what did it do? As soon as I was just getting in, let's say right here, the market turns around and starts to trade back under. That is not supposed to happen. What's supposed to happen is supposed to keep going up. When it doesn't keep going up, if I don't get that I can't know the future, I might be tempted to stay in that trade because I'm expecting that, well, it'll turn up eventually. But that's not the way it works. The way it works is, it looks like it might be about to go back up. I take a chance, but if it fails, the only way I can save myself is to get out quickly. Now, if I am looking at this at the same time and I see there's some good buyers sitting there, then that's more incentive for me to actually get in because I can see their buyers there. Probably I won't see massive amounts of buyers sitting at some random level, but if I happen to see there's a good amount of buyers there, more incentive to get in. Most importantly, whenever these big transitions from down to up or from up to down occur, like here, almost every time it's because the market hit a major level of buyers. So let's test that theory and see if I might be right, okay? Because you never know, I might be wrong about that, but let's find out if I am. So what I'm going to do is I'm going to pull up Bookmap, since that keeps a history of what happened. I'm going to put in Tesla, because I believe that was the stock we were just looking at, right? Yep, Tesla. All right, now Bookmap is a more advanced tool. It's Bookmap, as I've said many times, all it is a summation of what's on this, the level 2. So just like the chart, the price chart is a summation of what's on the time and sales. Bookmap is a more it's a more like 3D image, as I like to think of the history of what's happening in the level 2, but it also shows me the time and sales if I want. I could actually pull it up there too. So it has a price history. That's the lines that you're seeing here. Here, let me just, where is it? Last price. That line there, that's a price history, just like any other. All this is showing me is what's already happened, right? Nothing more, nothing less. Let me add some historical data here. Give it 1 second. I'm just letting it load up from. Oh, I didn't know they use DX feed. Oh, that makes sense. So they're actually using this. Actually explains why the data feed's so much faster than Thinkorswim. They're using DX feed through the platform. Pretty cool. Couldn't figure that out until now. I didn't realize I was using DX feed, so that's why it's so fast. If anyone's ever used DX feed, it's pretty fast. That's why it costs so much. So I don't know how they made this deal, but that's a good deal. If you can get DX feed through Thinkorswim, that's awesome. All right. So anyway, this is the price history. Notice there's something missing here. Reason being is with Bookmap, if you load it too late, the price history actually is missing. I don't know why, but let's just add the heat map, which is more important. There you go. Now that's the stuff. That's what I want to see. So here's the heat map, and let's find out what was happening at the time that the market got down, went to its low point, and went back up. So according to the chart, and again, I don't know this in advance. I'm literally doing this on the fly. So if you think I'm sandbagging here, I'm not. I actually didn't know until I look at it what's going on. So if I zoom in, I can see right there. Hold on. If I look here, I can see there was a level there. There's a big level at 185 that wasn't hit. And as we were going down, we're kind of moving through some lighter volume. Nothing heavy, but you can see like these little shaded areas. That means there's actually volume of bids there. So we hit a big bidder there, bounced up, got close to this one, didn't actually hit it, and then we start to go back. And that happened at 11:53 Central Daytime, so 11:54 or so. So if I look over here, this says that it occurred at 12 something, which by the way is Eastern time. So if I add the info panel, that says at 12:54 p.m. Eastern time, and this says at 11:54 Central. So let's conclude what we just learned. Market came down to a level. It came down through several levels. This is one. It didn't actually reach this one. It got close. Didn't actually hit it. But notice that the transitional move occurred near this level. After hitting a smaller level, it turned around and went back up. Now, it actually occurred primarily, in my opinion, because of what happened with Apple. Remember I said that Apple is generally the leader of the pack. Here's Apple. Apple came down to that level. Time index is 1247, 1250, 1254, and then it starts to go back up. If you look on your charts of the QQQ, you're going to notice that around the same time that all these heavy bids were appearing on Apple and we went back up, the NASDAQ most likely also went back up around the same time, maybe slightly sooner, maybe slightly later. The futures market actually kept going down at first, but as soon as Apple stopped and started to go the other way, the futures actually started doing the same. So Apple, yes, that's what it indicates. Exactly, Cynthia. Buyers and sellers. Buyers if you're below the market, sellers if it's above. So it's just looking at the time, it's looking at the level 2. You have bids and offers, and it's showing how deep they are. See these peaks over here? That's actually showing how many shares are at each level. So at 158, not exactly at 158, but there around, plus or minus about 10 cents, you have about 23,767 offers. Down here, you've got about 19,500 offers around bids, around 156. you have 20,178 shares around 155.90. That's the total number of shares. So what this is basically doing is showing me the exact same data. So if I go to this over here, guess what I'm going to see? Right? So it shows me on Bookmap that we've got about, let's say, about 15,000 shares. And if I go here, they're right. I don't know if you can see it's moving around a lot, but the shares there, I don't know, it keeps flashing in and out, but they're right there. There's about 11,000 something shares that keep popping in and out on the screen. I think we actually maybe we hit them and took them out, but no, we didn't. They're still there. So it's hard to see it because it's moving around, but you'll see a flash of about 15,000, 13,000 shares on here every now and then. Okay, so that's basically what this is tracking. Okay, so in short, it's easier to track on here because it's a constant thing. Um, it's a constant display. So even if they flash the order, then take it away here, it's still keeping a track record of it here. So we know that it was there until it's totally gone. We still have a level there. We can't see the whole thing right now because the market. I'm sorry, I'm looking at the wrong stock anyway. Sorry, Apple. Sorry, I didn't even realize that. Apple. I guess Tesla had it too. There it is, right there. Sorry, it's just moving too much. But 157.50, right about there. There's a big level, and that's exactly where it says it is here. Sorry. Yeah, I am. I am. So the point is, guys, this level there that's flashing around, just like we saw for Tesla, Tesla must have a level above it too. I didn't realize I hadn't changed the screen. But there is about 11,000 or so shares sitting at 157.50, which is what Bookmap is showing as well. So even if I didn't have this, I would still see it here. It's going to change a lot. You're going to see this thing move so much you might not notice it. In other words, you might not be able to sum in your mind quickly that there's 13,000 shares looking at this whole thing moving around. This is a computer over here summarizing it for us, just like a chart. So just like it's hard to keep track of the time in sales because it keeps moving, same thing. It's hard to keep track of this because it keeps moving. I freely admit it. But if I have something that summarizes what's already happened and what's there now, much easier. So what this is doing is taking the information from DXFeed, which is a major data provider in the industry for trading. It's summarizing what the feed is showing and putting it on a graphical display. So now I know that the reason why Apple had a hard time getting through here wasn't because it didn't have any interest. It just hit a level that it didn't have enough orders, but market orders to buy through that level. Okay, let's keep going. Now, if I go back to Tesla here, okay, same place where Apple bottomed out, Tesla also bottomed out around the same time. Remember, the markets tend to move as a pack. They tend to move as a herd. So if one thing's moving, other things are probably moving the same direction. If it's a major stock, Apple, of course, is the biggest stock of them all when it comes to the indexes. Tesla is no longer the biggest stock of them all. It was briefly, but Apple's been the title holder for a long time. So it just told the little guy to step back, and it went back to where it was. Anyway, if you had known this, if you had known that this was happening, and you were looking at a chart and it was Apple, okay, and it was Apple down there, 156. You guys remember earlier, I mentioned 156, did I not? Anyone vouch for me that I did mention that earlier? Multiple times? Some of you saw it too. You say, hey, it's getting close, it's getting close, it's getting close, right? So we hit 156. As I mentioned, it didn't look like the market was done going down. It looked like it still wanted to go down because even after it got close to 156 before, it just tapped the side of it, went back up. Okay, if I look at the history here, It came down to it here. It jumped back up, went to the VWAP, danced around for a bit. Notice that it's hitting another level up here, stopping it from going up. Then it came back down, slammed into it there, couldn't go through, turns around, keeps going up. Looks like someone thought it was going to break through, so they threw some bids here, but they never got touched. These little bids there, looks like someone was thinking it was going to break through, so they were trying to catch it on the way down. It didn't go any further. Notice that this one showed up underneath it. That didn't get either. This turns around, goes right back up to the VWAP first, and then notice where it's peaking out at another level. Okay? No real trend on Apple today. It's just basically down and up. But with the right information, you could better anticipate turning points. So if I see here, this part here happened right there. Same time of day. Same thing. That is that. This is this. Hit it, turn back around. If I knew that was there, and I see this transitional move on the chart, what would I do? What would you do? If you knew there was a level there, you knew it was a big level, it came down to it, couldn't go through, turns around, a perfect reversal on this chart, would you not be more inclined to buy? Would you not be saying, okay, that might be it. I might want to take a buy right there. Does anyone not see what I'm saying? Is this not, if it's not clear, tell me. Making sense? Okay. So, what this means is, if I can combine the data on the level 2, one way or the other, either looking at it raw, like we're watching the Matrix movie and he's looking at the data feeds, like, yeah, I see blonde, brunette. Well, maybe I'm not that good. So I use Bookmap instead. Maybe. I have to pay for it or I get it for free. If I get it for free, I can look at Apple, Microsoft, and the E-mini S&P. Which, honestly, as long as you are disciplined, that's all you need. You can do this on 2 stocks if you really want to. But it's nice to have it on other stocks too. But guys, the key is this. No matter what tools you use, the key is how you manage that trade. Okay? I'm just making it as clear as I can. You can use Bookmap all day long. If you don't have discipline, even this will not make you a successful trader. It's just a tool. But if I'm willing to cut a loss when it's not working out quickly, then I might actually be able to make good use of this. But if I'm just going to hold on because I was thinking it was going to bounce off that level and it didn't, but I hold on, and I hold on, and I hold on, is that going to work? No. Because I'm not using my head. I'm just not willing to get out. None of these levels is guaranteed to hold. It doesn't matter how strong it is, the market can still go through it. As one of the guys who taught me said, if the market never went through support or resistance, then we would always be trading between the same 2 prices. Exactly. So because we see that the market can move, and because there is an actual limit to the number of shares that are available, once they're gone, and there's still people needing to buy or sell, then the price has to keep going. Which means in any really good trend up or down, you're going to be breaking through level after level after level after level after level. But when the market can't figure out where it wants to go and it's just basically trading sideways, but it's swinging in a good range, that's where this really shines. If I got a stock that's a runaway freight train, like what was the stock this morning? PAP something, whatever, PXSY, if I remember correctly, the symbol. If you got something like that, it's just going to keep going. It's in other words, this information is not critical when you have a stock that's just on a runaway freight train move. PYXS, thank you. If you're on a Runaway freight train move, it's just not going to stop. It's just going to keep going until it finally reaches a point it can't go any further, which will probably be some big level that it finally hits, or it may be nothing. It may not find any big levels and it just runs out of steam. But if you're dealing with a regular stock like Apple or Microsoft or Tesla or Nvidia or AMD, believe me, they're going to have clear levels. And as long as you zoom out, Scott, as we always say, zoom out, see the big picture, the whole thing, not zoomed in like this. Zoom out, see more of it. The more you can see, the more likely you're going to time the entry better. Okay? So as long as you can see the whole context of what's been happening today, you do know what the big levels are, right? Now, if I scrunch this down too much, I'm seeing too much information. I don't need to see 160 today unless the stock's moving that far. All I want to see is what's nearby, what's in the range of what we're seeing so far. And if that range gets bigger, then I zoom out some more. As long as it's tight, that's as far as it's been today. Okay, that's all I'm going to look at. I'm not going to look any further above or below than I need to see what's going on here. Okay? Now, so if I know that it's key levels that cause these changes in direction when they get hit and the market can't go through them, then when I see a stock starting to transition on this chart here, all I need to do is look and see, is that a big level that we just hit? Now, once we hit that big level and we start to trend up, normally there's not going to be another one nearby, which means when you get into these trends like this, you're basically in no man's land. There's nothing nearby that's going to, stop the trend. It's just going to keep going for as long as it can, right? Now, this is the important thing to understand. When there's no major level nearby, Newton's law usually applies. An object in motion tends to stay in motion unless acted upon by equal and opposite force. Simply put, once the momentum is going in one direction, unless something is stopping it, yes, it has inertia. It tends to keep going. It doesn't go in a straight line. Notice there's lots of pullbacks in this. But if I were to zoom in just a little closer, a lot of those pullbacks probably went down to some little minor level that was there at the time, or the stock just hit off of a major level above that kind of knocked it on its side and then came back. Like here, hits a level, pulls back, then continues up, right? May not be a big level that actually was support. There was kind of one there, but the point I'm trying to make is even if I try to zoom in, I'm not going to see that much more than what I already know. The stock's going up. It went off of a big level below, and it's probably going to head towards a big level above. Remember that in order for trading to work, buyers have to find sellers, sellers have to find buyers. So the market already knows these levels are there because if I can see them, guess who else can see them? The people with enough money where they can actually take these out. They can see them too. So if they need to buy, then maybe they were buying down here too, and they still need to buy, and they say, hey, as long as I can buy up to here, I'm fine. Then they keep buying. And when they get to here, if they still want to buy, they buy through that. And if it keeps going, then it goes to the next level, right? So all I'm doing is looking for places where the market might be stopped after it hits a major level. The first place I'm looking is the VWAP, the normal VWAP that's in this chart, also the one you would see on Thinkorswim, or if you add it to here, same VWAP. So if I add the volume weighted average price here, the normal one, which is a cumulative, right? If I add that, yep, I'll make it in purple. There she blows, right? So that is the normal VWAP. Now mine's not going to, well actually it is going to be correct because I have the overnight data. So it's going to be slightly different. This is, yeah, 156.80. It's just very close. It's about the same, right about there. It looks a little different, but it is the same thing. So my point is, the VWAP is where the price is likely to go to first, okay? So when it goes up, it's probably going to go to the VWAP first. Then once it gets to there, If there's nothing that's holding it back from continuing, then the next place it's probably going to go is wherever the next big level is. Now, some of these levels are not as big, but they do seem to have slowed the market down a bit. But eventually we got to here. Now, I'm not saying you should wait till it gets all the way to here. If it doesn't look like it's getting there, then you don't have to stick around. But if you can catch it on a rebound, where it pulls back first here, then it starts to resume again. You already know where you're likely to go. You have your downside risk right there. You can see if it falls apart, then you get out. But that looks like a pretty clean reversal to me by the time it got to there, and I have a target above. So all I have to do is calculate in my head, is the target at 157.50 right here worth the risk of going down to there? If it's not, don't do the trade. If they're pretty much equal, then don't do it. If they're big enough or you think it can go past it, then do it. Okay? So as a beginner, the only thing you want to do is just do the calculation. As long as it's at least 1.5 to 1, meaning that if you have to risk $1, but it's realistic you can hit that $1.50 profit, then take the trade. If that's not the ratio, don't take the trade. Okay? As you get more advanced, you'll get better at judging whether or not there's more room to go than what it looks like. By the way, you see how this is getting thicker here? All of a sudden you see all this orange and stuff? This is what happens at the end of the day. Bids and offers are flooding in now to saturate the market right before the close, right? So you're going to have, and also big rounds of aggressive buyers and sellers will also start to kick in. And then once we get to the close, all this is going to poof, disappear. You're going to have one final trade, which is the closing cross, which usually is the biggest trade of the day as far as volume. That's going to dictate the closing price. And then it's all going to be post-market and it's over, right? So guys, when I tell you that trading is straightforward, I mean it. It's not the technical stuff that's the problem. Okay, I can show you this every single day. It's going to be the same story. Market hits major level and reverses. The more the market's been going in one direction for a while, the more likely that's going to happen. Now, you don't want to obsessively look for every price level. That's a mistake a lot of people make when they start using something like this. They're looking at every level. Focus your attention on the ones that really stand out. So what I do at the beginning of the day is I scrunch it together first just to get a sense for what's around, and then I ask myself a question. Does it look like today Apple could get to 160 or down to 155? If the answer is yes, then I might leave it as such. If the answer is I'm not sure, I'll just zoom in to where I can see the range it's already in. So maybe at the beginning of the day it's only down to here, but I would say, all right, well, if it's been able to get this far in 10 minutes, it could probably go that same distance if we give it another hour. So I should be looking at least down to there. I actually looked even lower. I looked a little lower and said, well, the next big level is at 155. I kept that in mind. But once it got down to 156 and it was clear that was the level, then I just zoomed in and said, okay, that looks like the floor. So let me just zoom in. So I see only the floor. I know there's another level below it. So if it breaks free and it comes down, then okay, then it goes to the next level probably. But if not, notice that dissipation, as I said, you see how it just went poof? It just went away like a disappearing act. Just like that. All that was there, and then it's gone. Okay? So folks, what have we learned today? The market is just a machine. It's a machine like playing Plinko on Price is Right. If you start the chip, the disc on one side, it's probably going to end up closer to that side. If you start on the other side, it's probably going to end up closer on the other side. If you start in the middle, it's probably going to end up closer to the middle. That's it. That's all the market ever was or ever will be. No matter what tools you use, whether it's Bookmap, whether it's technical studies, trend lines, whatever you use, nothing predicts the future. But the one benefit of knowing where levels are is that you can see how big they are. And when the market gets there, you can judge if it even appears that the market has the strength to break through. So if I see that a little child is trying to push a motorcycle forwards, probably they can't do it. They might be able to, but they probably will struggle. But if I see The Rock standing next to my dirt bike or whatever, and he's trying to push it, yeah, he probably can do it. He could probably pick the thing up, right? So my point is, if I see The Rock style strength in the market, then maybe it's going to break through a level. If I see a child's strength in the market, proverbially, probably it's not going to break through that level. How would I know the difference? By watching. Just keep watching. After you watch something long enough, you'll get a sense for what is strong and what is weak. If you look at the time in sales, how many times in a day are you going to see a 50,000 share market order? Probably never. How many times are you going to see 100 shares? All the time. 500 shares? All the time. 1,000 shares? Not all the time, but a lot. So if I see an order has 180,000 shares to sell, chances are that might hold for a bit, right? And if it breaks, as long as I get out quickly, no problem. But the benefit is this. I can short sell at 158 and be out by 158.07 and know that I'm wrong because it broke through. But if I don't have that, guess what I'm going to do? I'm going to sit in my trade and sit in my trade and sit in my trade until it's gone farther. This is on Thinkorswim. You have to go to the help desk there, the chat, and you create a support request, and you say the following: please add bookmark to my Thinkorswim. Thanks. Thanks. And what they're going to do is come back and say, do you have a subscription or are you looking for the free trial? Just say free trial. Then they're going to turn it on. And next thing you're going to see is this right there is going to suddenly appear on your menus on Thinkorswim. You're going to see Bookmap. And once you see that, you've got it. And you click there, it's going to bring up a chart window. It's going to be empty at first. It's going to have three options: Apple, Microsoft, or the ES futures. Just as a quick note, you can have more than one window in Bookmap. I don't know if everyone knows this, but you can have more than one. You can have as many as you want. Okay, it works just like any other charting in Thinkorswim. So if you want to watch Microsoft and Apple at the same time, you can set them side by side or vertically, whichever you prefer, and then you'll be able to see it. Okay, so essentially just set the charts up as you please. I usually have mine set up where I'm looking at the five major tech stocks: Amazon, Microsoft, Meta, Apple, and Google. Those are the five I usually have running at all times. The reason for that is I'm trying to see where the market might turn by watching when those stocks are getting at their major levels at the same time. In other words, when you get conversions where most of those big stocks that make up the majority of the influence of the S&P, when they're mostly at the same place on their relative chart at the same time. In other words, Apple's at a major bid, Microsoft's at a major bid, Meta's at a major bid, Google's at a major bid. If they're all at the same place at the same time, most likely it's going up. It is. Scott, I'll freely admit this is a data hog. So you might want to only look at one chart at a time. I was just letting you know if you wanted to, you could. I don't know. I know at minimum, the minimum RAM I have is 64 gigabytes. But I know I have my other computer at home is like 124 or something like that. 120 something. Um, so um, i7 or better, you know. Yeah, Thinkorswim is a hog. It is. It really is. True Edge in comparison is not. That's actually another big difference between a professional platform. Professional platforms are designed to be very lean. They don't. Yeah, there you go. Professional platforms typically are more about the data speed than anything else. So Thinkorswim has a lot of junk on it that I never use and you never use. This is easily the most useful thing on Thinkorswim for day trading by far. By far, like it's not even a comparison. This is the most useful thing by far. But the key here, guys, is to understand that all it's doing is showing us things that we can't see on a regular chart. There's no way I would know until we get there. But some people in the old days, they would look for volume spikes at lows like this, and they would use that to interpret that probably a big level was just hit. That's not a false philosophy, by the way. That's actually true. That when the volume suddenly spikes and you're at a low or a high, a swing low or swing high, probably that means you hit a level. But this lets you actually see it before you get there, which is the big deal. That I can actually see it before I get there. I'm anticipating that the market could get there before it's actually there. That is the big deal. And basically, anytime you can make projections about future price movement, always worth its weight in gold. Much better than not being able to know. So, although the levels that I project are not based on this exactly, I would like to incorporate that, but that would take a long time to actually get. My experience with programmers is it usually takes a while for them to get what you want. But my buddy's working with a guy right now that actually specializes in that. So once they're done, I'll probably talk to him to see what he would propose. But I think based on the price I heard is pretty reasonable. So if I could do that, then of course I might be able to. Well, I'll talk to him and find out. But if I can actually make it possible for people to get all that data, I will. But I have to find out if that's even doable. Anyway, point is, once you know where the levels are, a lot easier to figure out what's going on. Okay? So whenever you see a major turning point, it's not guaranteed, but it's almost guaranteed that it happened at a major price level. Hit something that reversed the trend, usually. Not always, but usually. Okay? So if we look at Apple's action today, let's just summarize it really quick, and I got to run. There's Apple at the start of the day, it went up. There's the opening price in green. Notice that at the opening of the day, let me scrunch this together. At the opening of the day, notice that we peak where? Just where this level was at the time. It wasn't as big, but it was there from the beginning of the day. So it was much thinner at that point. The market went up to it when it was a thinner level. It didn't even last. It came down. So maybe they put more offers up there or after the fact for that reason. But they basically mapped this out like that's a level, 158. Okay? Then, after the start of the session, the first major pullback we have is here. There was no major level there at the time except the VWAP itself. And the VWAP is not like any bids or offers are there. It's just trading tends to get intensified when you get around it. And then it goes back to what it was before. So apparently there was no major level there, but whatever the case, it hit the VWAP and went down. Hit this little level there, blew right through it like it wasn't nothing. We were actually talking at the time it happened, 156.50 when it broke through. Came down to a small amount of bids that were there trying to catch the market ahead of this level. Then finally they got taken out. It hit this level at 156.04 if I remember correctly. Then it turned back up, went back to the VWAP, and then it hits this level up here, which was at 157. If you look on this chart, there it is, right where the VWAP is as well, at least on this chart. All right, so we turn around, come back down. We hit that 156 level again. That level got thicker than it was before. You can see the red got darker. So there was more stuff there. It chewed into it for a bit, couldn't get through it, turns around, goes back up to the VWAP again. Briefly hits a small level of liquidity right there, then goes up, hits a small level of liquidity there, goes down quickly, then immediately goes back up to this level, pulls down again, comes back to it, this time breaks through, hits that level, and so forth. Okay? So the entire day, It's not that every turn is at some major level. That's not the way it works. But what we're saying is when you get to a major level, the probability of a strong reaction goes to basically 100%. You will get a reaction at a major level. Either a much more order flow will suddenly come out of nowhere to eat through that level, maybe because they need to get filled to buy or sell, and they see an opportunity, they throw everything at it. But if everything they throw at it's not enough, all the sellers just got removed from the market. Not enough of them are left. Only small sellers are left. The big sellers are gone, which means that any significant size buyers will have more than enough power to move the market all the way back up. And that's what happens. Okay? And if we hit a level above, the major buyers are gone, small buyers are left over. They're not enough to keep it going up against that big offer. Other sellers take over and move the stock price down. Doesn't matter if this is intentional or not, that's the way it works. So if we know where those levels are, we can better analyze technical trends to figure out where entry points. But just remember, once we hit a major level and we start to trend up, there's not going to likely be anything substantial in between there and the next big level, which means the stock is going to be on inertia. And when you're in inertia, just like any good trend, all you have to do is use this tool, this simple tool of Bollinger Band, to basically help you figure out where the pullbacks are and when they're starting to go up again. Sometimes it goes to the middle and goes up. Sometimes it goes deeper and goes up. But either way, as long as it's still on trend, a pullback is a pullback is a pullback. So pullback starts to go back up. Okay, I'll try to get back in. Pullback starts to go back up. Okay, I'll try to get in. Right? This one sold off, almost was done, then sharply reverses. Okay, I get back in. Whatever the case may be, I know why it's going up. I know where it's coming up from. I don't know if it's going to keep going, but I know where it's heading. Make sense? Any questions about that? All right, it'll take some time to get used to, so don't expect that you're going to walk in. It always makes sense, of course. It takes some time to get used to, and you're right, execution is another thing, but that mostly comes down to you. You already know where to look to get in. Stock goes sideways, starts to go back up, fine. Generally speaking, when I'm talking about this stuff in the daytime, I'm not actually looking at an individual chart for every stock we mention, right? Simply because there's not enough time to let it load up. So if I see a stock that looks like it's on a decent trend, I'm just going to point that out. Whether or not it's going to go up, we never know. But if you want to focus your attention on specific stocks only, this is the way you could do that. Otherwise, I just look for things that look like they have strong momentum. And then once they're clearly moving, then we can figure out where they might be going to. Okay? All right, folks. Have a good one. I'll put this on the YouTube channel shortly, and then we'll pick up from there, okay?